Welcome to Wealth Management Mixtape, a go-anywhere show about life, finance, and investing. Join Jake Heisler and Tim Miller as they talk about what they're reading, writing, and experiencing. Jake Heisler and Tim Miller work for Quaker Wealth Management. All opinions expressed by Jake and Tim or any podcast guests are solely their own opinions and do not reflect the opinion of Quaker Wealth Management. This podcast is for informational purposes only and should not be relied upon for investment or financial planning decisions. Clients of Quaker Wealth Management may maintain positions in the securities discussed in this podcast.
All right. We're continuing on, I guess, here, huh? I was just looking at earnings. Today is... when we're recording is Thursday the 28th, so Amazon just had their earnings call. It's a loss of $7. That was a surprise.
Yeah.
What did they do? Thoughts?
Loss of $7.
They're down 9% after post-market. That's big for Amazon.
That's usually not a great indicator for the rest of the market.
I was just saying to Nick in our office that if that happened to any other like smaller company, man, I mean, $7 on 2,600 is not a huge, or 2,800 is not a huge deal, but any other company, that would be like, it'd be like some other stocks we'll talk about today in a second. Yeah,
but it's unbelievable.
Anyway,
I guess that leads us into our first topic of the broader market, right?
Yeah, it's been a wild year so far. So we'll have it pop up on the screen here in a second, but everything is down this year, seemingly, except for maybe energy. And if you own inverse bonds or something, I don't know. But this is the worst year for bonds, or worst quarter for bonds in the last like 40 years. And if you look at the year-to-date chart, everything's down in unison. So from the Dow, which is down 6.5%, but that includes consumer staple names, so it's held up a little better. And the Nasdaq down 11, S&P, which is kind of a blend of value and growth, is down 9%. I'm sorry, the Nasdaq's down 19%, and then the bond market is down. Where am I looking here? 9%. There it is. That's wild.
Yeah, I also read that like retail sentiment is at its lowest level since March of 2009, since the financial crisis. I would think that the bond market would have a big part in that, because even more conservative investors are still feeling the brunt of the down market, given the fact that bonds are down 9%.
Well, if you look at it, if everything is down 10%, it doesn't matter the blend of your portfolio. You could be 90% stocks or 10% stocks, and you're still down 9%, right? If you blend together the ag and the S&P. So it's rough. Zoom out, right? It's always important to zoom out. So we talk about with our clients that, 4 months doesn't make or break the goals you're planning for. It's always important to put things in the context of your goals. But if you zoom out to 10 years, a little bit of a different story, at least for the equity indexes. The Nasdaq's up 365%, including the recent downturn. S&P 258%, Dow 223%, and the lonely aggregate bond index is down 7%, really from this year, I guess. So, man, you've lost effectively holding bonds over the last 10 years.
That has to be largely due to the downturn this year.
Yeah,
you would think
it wiped out all the gains this year. It's always difficult when everything moves down, and that's always a challenging time. So it's nice to have balance in the portfolio. So if stocks are going down, bonds are going up to a certain extent. But I read somewhere we're 2 generations removed from dealing with a bond market like this, and that market is a steadily rising interest rate. Like we've been in this long drawdown and and falling interest rates. So people have been getting more. So rates go down, bond prices go up. People have been getting kind of more juice from their bonds in the last 20 years than it kind of moves in cycles too. So I saw one projection that we're in the beginning of the next 20-year cycle of rising rates. So good news is you get paid more income. That's a silver lining to all of this. But the bad news is if rates go up, bond prices go down.
Yeah. Wow. That's unbelievable. 20 years removed from the last, bond market of lower interest rates.
It's the challenge is from our perspective as advisors is how do you balance the portfolio out if it's assumed that you're in a rising interest rate environment. You can shorten the duration on your bonds. You can do some bank loans. Theoretically, municipal bonds aren't as correlated to interest rates, so they are right now. So it's a challenge. And there are more eclectic funds out there now, like inverse funds, where you essence you can be more market neutral on the bond side of things. But it's a challenge.
Yeah, definitely. And then you had GDP numbers come in. What was it, yesterday? So
so that was a shocker. Minus 1.4%. It was forecast, I think, at a positive 1%.
Negative 1.4. Wow.
But it's good to look under the hood on these. So it's not as, I would say it's not as bad as it looks. And the market was up a bunch today, So if you kind of dive into the data, it's Nick's writing a piece for our clients on this. I think it's going out tomorrow. But he breaks down the components of GDP. And one of the biggest contributing factors to the negative side of that number were net exports and inventories. And that would make sense because everything was kind of the supply chains are all messed up. There were a bunch of cargo ships waiting to unload their inventories or stuff to the ports. So that would make sense. But some of the more important items were actually good. So domestic purchases, so consumer spending was positive. Actually, that was up over last quarter. And so, household demand and then additionally business sentiment or business investment was also positive. And this is being echoed in a lot of the transcripts. If you go through them from their earnings reports or this earnings season, is there's kind of a consistent theme with most folks, which is, we've seen spending go up on the consumer side. So I think what corporate America is trying to tell us is that there's some good news in here. People are still spending money, and at the very basic levels, money being spent on stuff drives earnings over time.
Yeah. And I think they're starting to see a lot of these supply chain issues start to ease a little bit as we come out of the pandemic here. So in future readings of the GDP numbers as they come out, it should be a little bit better every single time, right?
Yeah.
Some of these positive numbers should flow through a little bit better than they did this reading.
Yeah. We get some questions too about how does a reading like this affect our portfolio models or modeling in the future? And it really doesn't. If you look backwards, there's no one economic data point. Let's take GDP, for example, that is an indicator in and of itself. So you need the way we do things internally in the office, we're like giving away the special sauce, is that we have kind of a grouping of 10 different indicators that when there's enough red flags, for us it's 7, that's an indication of potential future market turmoil in a more drawn out way. As we've said before, we're long-term investors, be diversified, have a long-term focus, but we strategically shift portfolios around. And so nothing setting off alarm bells here in the office just yet.
Yeah.
Positive stuff, Facebook.
That's what I was just going to say. Yeah, Facebook. So we just talked about Amazon, which had a negative $7 per share come out. But on the positive side, and I know you like to say, don't bet against Mark Zuckerberg, right?
Don't bet against the Zuck.
the future, the metaverse is the future. We'll all be doing meetings virtually, right? I think that was good to see that Facebook kind of regrouped a little bit, and there was some positive earnings that came out here, because there was a lot of negative sentiment around companies reporting earnings. Obviously, there's been some companies like Amazon and a couple the other day that weren't as great, but there's been some positive signs as well. I think when just looking at this market in general over the last couple months, the one thing that I've noticed, and I'm sure a lot of other folks have noticed as well, is even when these companies post positive earnings results, there's a pop in the share price maybe the day after for a few days, but it doesn't sustain any real momentum going forward. So we're in a tough macro setup, or we're in a tough market environment right now with a lot of different headwinds. And I think once you start to see some of these companies have sustained momentum in their stock charts, then that's when a lot of people will start being less pessimistic on the market. But until then, it's really tough right now to.
That's a really interesting point, because I think stock pickers, I bet the best time to be a stock picker, a pure stock picker, right, is when really bad news becomes less bad, right? Because everyone's so bearish and feeling awful about the market, and it ticks up slightly, and then there's this mad rush back into the market. The opposite might be true too, that really great news gets less great. And so to your point, Facebook has a bump. How long does that last for, right? Does it come back down again at some point in time in the near future?
Yeah, I was listening to Josh Brown on CNBC yesterday. He was kind of expanding on this point where you can't really trust any of these companies who report good earnings right now, just because we've seen it over the last however many months where they post positive results, and it just gets overshadowed by the negativity in the market right now.
Yeah, it's tough it's kind of like golfing into the wind. It's just a tough thing to do. So you got to be really confident in stock picking in this type of environment.
Yeah. And then you had Netflix as well, right? And Netflix, another big one. What was it? They reported last week, and they had their worst trading day since 2004. I guess that was recent, almost close to if it wasn't their IPO. But they actually lost subscribers, which was a shock to a lot of folks. So not only did that post a positive gain in subscribers, but they lost subscribers from a year prior or quarter prior. This seems to happen with a lot of those stocks that did really well during COVID. And it's just, I think it goes back to the changing behaviors in what people perceived as the new normal really has started to fade here. So those new normals and thinking that we're going to be sitting in front of our TV, half of the day, everybody's working from home. Now you have people returning to the office, and a lot of those behaviors, we've seen it in Teladoc as well, who reported today, where a lot of these companies didn't have as large of a moat, or didn't have, some of these things that people kind of baked into the share price aren't able to last once people started return to, life pre-COVID. So we've seen that in Netflix especially, and then they've had competition, Paramount, Disney Plus, all these other streaming services, which I actually wrote an article about coming into the market, starting to offer different things that maybe Netflix doesn't offer. And then obviously to keep a leg up over the competition, the one thing you have to do is have really, really great content. So create engaging content. And the one thing that comes with engaging content is that it costs a lot to produce. Right. So you have to pay a premium for this content that people are looking for. But you have to produce so much consistent content that people are willing to come and stay. And I think there was just a stat out there that like 33% of people or 33% of people who pay for a streaming service were either have canceled or were planning on canceling one of their many streaming services. Say if they had two or three, they're going to cancel at least one this year. So either they're going to consolidate down to one and you're going to have one winner, or you're going to have a couple that are able to survive as people start to return to normal life.
We had an interesting quote that I think was from Derek Thompson. Actually, I don't know if he said it or he's just quoting another person. But he said, the history of media is the rebundling of unbundled bundles. We talked about it in the office. Like it's cable, And then now it's these streaming services. But at some point, someone's going to come back and bundle these streaming services back together. And it's going to be a one-stop shop where all of the movies are organized by category. And when you click on one, it just takes you over to Amazon Prime or Prime Video or Netflix or Hulu or whatever. I have a question. I was just thinking about it right now. Netflix gives Aaron Sorkin, right, like $100 million or something to make 5 shows, right? But YouTube doesn't give anybody, well, they pay them a little bit, revenue, but people willingly create content and put it on YouTube in exchange for no value. Like, what do you think? YouTube would have a gigantic leg up on competition for this future marketplace? I don't know.
That's interesting. Yeah.
They spend no money. Well, I mean, they do, but they spend no money relative to Netflix.
Yeah, they do spend money. And they do pay people for hosting that content.
But not initially.
Not initially. Yep.
Right. So there's this runway of, okay, they're $80 million ahead of Netflix on the Aaron Sorkin contract.
Yeah.
So I don't know. Somebody gets discovered on YouTube and then, they get compensated for it. And then Netflix pays them to do a show for, $30 million or something.
So in a way,
I guess there's this kind of like conveyor belt of streaming services that you kind of move along as you get more and more mainstream or popular.
Because if you're the creator, don't you want to get paid up front by a Netflix?
Yeah, I mean, we post. It's like, what if we held out to post our podcast? Or like, people.
I don't think anybody would be worried.
Well, that's what I mean. We'd never do it. So we'd. So there's some really good content on YouTube. I mean, some of the people that are, for example, in SNL now started on YouTube, and some of the highest paid entertainers, if we want to call them that, the Paul brothers or was it Mr. Beast, who I think he makes about $5 million a month from YouTube, something crazy like that. He's a whole story in and of itself because he spends almost that amount of money on a monthly basis too. He's actually a really good topic. We should cover it in a future episode because he hasn't changed his lifestyle whatsoever. I mean, he drives a nicer car, but he lives in the same apartment with like his roommates and all this money hasn't gotten to his head. At least it doesn't seem that way. I've seen a few interviews with him. Quite interesting.
It's pretty neat.
We
want to hit follow-up items from.
Yeah, let's do it. Yeah, because we talked about.
We did have a couple of things, yeah.
Last episode or the one before, we talked about the adoption curve as it pertains to a couple of different things, but in particular crypto. And that there's always this kind of reluctance in the beginning. Eventually it peaks again, and it becomes really popular, and then everybody's all in on it. And we're not even close to the peak. We're just kind of starting to get involved from an adoption standpoint. But we had referenced a couple companies that were, a few years ago were calling crypto a scam or Bitcoin, we're very anti-cryptocurrency. And then just recently, I mean, literally last week, I think it was, I sent you a couple emails with the headlines. One was from CoinDesk that said, it's from Morgan Stanley, who was one of the companies that denounced the idea or the concept of Bitcoin, I think it was. Now it's that Morgan Stanley says crypto could become more widely used as currency. And so they're talking about in particular, the ability of Strike, right, a payment systems company, who partner with a supplier, NCR, but it's the Blackhawk network, which allows large number of U.S. stores and restaurants to accept Bitcoin. We were talking about it before too, that there's going to be this point where and it's the Lightning Network on Bitcoin that allows for an immediate reconciliation for a fraction of the price that it costs a bank to do it. And so it's starting to happen. And so Morgan Stanley's saying, oh yeah, you can, not only is Bitcoin here and relevant, but it's going to be a payment system when it was never considered a payment system. Even a year ago, I would say Bitcoin wasn't considered a payment option. And now it might be. And the other one was Goldman, right? So they're, again, anti-crypto until they realize all their clients want to have access to it, their wealthy clients. And now they're looking at they're supposedly looking at an alliance between them and FTX, which is the large crypto exchange. And so there's like this underground, or whatever you want to call it, clandestine meeting between both CEOs at some point in time.
Don't you think it's almost inevitable that these large companies are going to be forced to offer Bitcoin and other cryptocurrencies? Like they have clients, they serve their clients. As their clients start to reach out and ask questions like, shouldn't I be investing in this, or should it be a certain percentage of my portfolio? Isn't it in their best interest to start exploring these options, even if they initially had a stance? And that's why you've seen a lot of them retract those initial stances and say, hey, we're not as pessimistic as we once were. The reason why is they're clients, right?
Yeah, of course. Why would you as a, let's say you've got 100 million, they work with incredibly wealthy people or families or foundations or that sort of thing. If your advisor or advisory team is not talking about the latest technology, or technologies, then wouldn't you be concerned a little bit, or at least exposing your portfolio to that in some way if the goal is to over time grow wealth responsibly, but grow wealth nonetheless? I mean, so at some point it has to happen that way. But as we've talked about in the past, this is beyond a payment system. This is beyond just paying with Bitcoin. It's the blockchain technology that's, that we think is probably transforming quite a few industries. And then we asked the question last week, which was, as you get older, does your perspective expand and become more empathetic and understanding of other people and other people's ways of thinking, or as you get older, do you just dig into your biases? And it was funny because we were kind of thinking the same way, which was, it just depends on the topic and the thing. Turns out, no. So I just happened to be reading a book. Literally, like, they started the book a few days after that episode, and called The Science of Storytelling. It's by Will Storr. Will Storr teaches, or I think he still teaches, a course on creative writing and how to develop characters so that the reader tunes in and is interested in the character and that sort of thing. And but he goes really into detail on the science of human nature and how we think and how we learn. And this is one of the things that I'm going to read it because I'm not going to memorize this, obviously, but I think this answers our question. And this is a psychological or a psychologist who chimes in, who's done studies on this, but says the brain. So kind of the context of this is, as kids, kind of through our adolescent years, our brains are very plastic, meaning we take external stimuli and develop our storyline in our heads, who we are, what our morals are, what we should be doing in our lives, what decisions are important to us and which ones aren't. And they're defined by a lot of different external forces. But then something happens after that where it flips the other way. And I'll just read a quote from it. It says, then the brain enters a state that's valuable to understand for anyone interested in human conflict and drama. From being model builders, we become model defenders. So when we encounter evidence that it might be wrong because other people aren't perceiving the world as we do, we can find it deeply disturbing. Rather than changing its models by acknowledging the perspective of these people, our brains seek to deny them. And then Bruce Wexler, he's a neurobiologist, said, once the brain's internal structures are established, they turn the relationship between the internal and external around. Instead of the internal structures being shaped by the environment, the individual now acts to preserve established structures in the face of environmental challenges. We ignore, forget, or attempt to actively discredit information that is inconsistent with these structures. So the answer is no, we don't adjust. And we were talking before this saying it probably feels like we change over the years, but that's probably just part of the storyline we're telling ourselves. That we're justifying certain changes in a certain, we're just
even like convincing ourselves that we've changed. Even if we say over time I've matured or I've changed in this regard, we can convince ourselves that, but have we actually really changed? And when you think about it, you can say, oh, we've changed, respect to a certain category. I've grown, leaps and bounds above where I was 5 years ago. But have you really?
Right. Has your
According
moral,
to
right.
probably not.
Yeah. If you really boil it down, and if you ask somebody else, an outside observer, they'd probably say not so much. But you think the part of the book in the beginning is you're the hero in your own story. You're the protagonist in your story. And so it's natural for you to condone everything you do or justify everything you do. And that you're this bigger than life character, that evolves over time. It becomes more empathetic and understanding of other people's opinions, and that's probably not true. You might have already been that way, right? But you're also kind of telling yourself a story that you've become better than you were. It was really interesting to me. It probably has a lot to do with why people invest the way they do too, and make the same mistakes over and over and over again. It's probably why technical analysis works to a certain extent. It's because technical analysis is just the reflection of human psychology on the markets, right? People buy until they stop buying, and they sell until they stop selling. And it's just this consistent, repetitive nature of investors that make it. Those folks that do technical analysis really well, really good at it.
Yeah, that's what I was gonna say. Isn't that where technical analysis derives from? Is human behaviors over time, and that's why it's able to be predicted through the use of charts, analytics, different metrics or scoring systems, saying, this is when we perceive there to be volatility in the market. This is when we think there's going to be, a run or some positive momentum in the market, and that's just due to looking at history. I know something we're going to touch on in a future episode is the changing world order. I know Ray Dalio just came out with a publication, actually has a book, but talking about he was so shocked by events that have happened during his 50 years in covering and being in the markets. But he said it's because the events that shocked him the most are because they never happened during his lifetime. So looking back, I think he looked back 500 years, and he found that different events triggered the same result time after time after time. And that just goes back to human psychology and the way that we act and have those ingrained behaviors at a young age.
I think it happens over and over again. That's why that charting works. It's a recency bias, which means that what's happened to us most recently is somehow more important than what happened before that. And so that's when the market drops 10%, you freak out, and that's why we zoom out and say, well, what happened in the last 10 years? Let's put this in perspective. And we have a little saying in the office that perspective is a superpower.
There's multiple things that can go wrong in any given year when you're talking about investing in the markets. And you're right. People always focus on, oh, well, this is the worst thing and this is the worst thing. But if you look back, even just 5 years, you say, oh, well, we went through that. We went through COVID. We went through, the stock market was down over 10% in December of 2018. You went down through the financial crisis. You went through the tech bubble. There are all these events that you at the time thought were the worst thing that could possibly happen.
Yeah.
And yet the market, as you already showed in the beginning, if you took a straight line from 10 years ago to where the NASDAQ is now, you're up 365%.
Right. And that's the funny thing. If you play that game of going backwards and saying, look, if you're here today at 0 and 10 years from now you're at 365% up, how you feeling? And the answer is great. And then, but as you say, but it's not going to be a straight line. It's going to be wiggly along that line, way up and way down, way up, way down. But you're still going to end up at the same point. And that changes everyone's attitude about the market, to your point, that there's this visceral reaction, usually on the downside. I wrote in an article that I was going back through the other day that, we never get phone calls during the run up in the market to reduce your risk tolerance. Never happens, right? In fact, you get some folks that are greed oriented that want to increase the risk tolerance during a run up in the market. So it's quite
Natural.
interesting. Human nature is crazy. I guess we're case in point. Hey, Elon Musk bought Twitter. We talked about that.
That was big news. That's another follow-up item. Elon Musk, I think it was close to $44 billion is what he actually paid. And I think he paid $21 billion himself.
Yeah.
The ironic thing that I saw was, and obviously when you have Elon Musk doing anything, there's always a lot of attention around it, especially with this and the board of directors and initially not seeming to want to give in to his deal. They proposed the poison pill, diluting their own shares and all that.
Yeah.
But the day after he bought Twitter, Tesla shares were down 12% the next day. Now, could that be fears that he's not as focused as he is on Tesla and SpaceX and everything else that he's already doing? But looking at Twitter, I don't know how much you can actually improve it from where it is today. Maybe we're wrong and there's something that we're not seeing that he is. But to me, how much can he actually do to it? I think the changes will be marginal at best.
Yeah.
And he got the endorsement from former CEO Jack Dorsey, which was in a really deep way of saying, I trust Elon Musk as the one person.
And the S&P was up 2.5% today, almost. And Tesla was down 0.5%. And down another percent post-market. So,
but I was saying, so he put up $21 billion, but by Tesla being down 12%, it was roughly the equivalent of what he paid. So he put up that money balanced out. Well, not really, because he's down twice the amount now. He paid for Twitter and he
that's true.
lost 21. So he's really down 42 billion in the span of like 24 hours.
Man.
Not actually, because he owns a company now, but it's a lot of money.
Is he going to be the first trillionaire?
If I had to put my money on it, I'd think so.
Yeah.
If I had to bet between him and Bezos. And that's the thing. Like when you get $100 million, is that like the rule of thumb that you have to buy a media company? Bezos buying the Washington Post, and then
you said
Elon buying Twitter.
100 billion.
100 billion. Yeah. Sorry.
Yeah, I don't know. They make odd purchases sometimes. Though I would say Bezos, there's a method to his madness. Don't get me wrong. I think Elon Musk is brilliant. He's just in your face brilliant, and so that can rub people the wrong way.
He tweets a lot, right?
He tweets a lot. He said he's going to buy McDonald's and to make sure their ice cream machines work. All right.
Did he say he was also going to buy Doritos and fill up the bags all the way? Something like that? Yeah. Whatever he does, every move that he makes is always interesting. So I'm sure we'll keep an eye on him.
The only thing with with Twitter is, I don't know how you've solved like the vitriol that happens on there. Again, going back to human nature, if I disagree with somebody, I now have an outlet to tell them directly, by replying to their tweets. And there's no filter because you're not confronted face to face. So there's this, we call them Twitter muscles. You just say whatever you want to say because there's no repercussions for it. So I follow this guy named Peru Saxena, who's an ex-hedge fund guy and just a really smart guy, and just gives his commentary occasionally on the markets and where things are. So just a pretty vanilla, Twitter account. He's not making any bold claims. And man, I read through his comments one day from something like, I think it was about the market going down and previous market drawdowns have tested the 40-month moving average. And man, the amount of awful stuff that was said about like him personally, it was just so odd to me. In fact, I actually tweeted at him and saying, "Hey man, I appreciate you, what you do." And, I don't know how, I said it in my tweet, I don't know how you stay on, this.
Why would you? What's your incentive to stay on?
That's what I don't get.
Following?
It's a shame because he's somebody that he's a smart guy who's balanced, not political in any way, and insightful. And man, I guess he just doesn't read his comments, but he must because he I think he liked my tweet, so I guess he's reading through his comments.
Has to be. I think the other thing we want to transition to was Fidelity.
Big
Now,
news.
yeah, big news. Fidelity is now offering Bitcoin in their retirement plan, so in their 401ks for plan participants. I thought that was pretty big news.
Does this mean that Fidelity will allow it to be in their 401k plans, but it's still up to the administrators of the plan?
Correct.
Okay.
Yeah, it's still up to the administrators of the plan. So the way I read it was that there's 23,000 companies that use Fidelity for the retirement plan. So not every company is going to want to implement this as an investment option in their plan, but they have a cap of 20%. So Fidelity imposes their cap of 20% max that anybody can put their current balance or future contributions into that Bitcoin holding account. But the administrator of the plan, so the company, can choose to set their own cap. So if they wanted to cap it at 10% or 15%, they could do so. They could also choose to not include as an option altogether.
Right. Okay. That makes sense. It's so odd thinking about Fidelity as the company that's been around forever and being on the forefront of this, but they've been kind of forward thinking when it's come to cryptocurrency. So there's somebody in the room that's steering them this direction.
I mean, I think you have to kind of, if you're looking at just the way things are going and your Fidelity and thinking, this is a way for us to differentiate ourselves against our competition, to be kind of the first mover on allowing this option inside of our retirement plans. I mean, I like it. You got to think about what types of individuals in those companies are going to adopt this as an investment option. If it were my guess, I would think it would be some younger individuals who are a little more speculative, not individuals who are close to retirement. They might be a little bit more apprehensive to put 20% of their balance into Bitcoin, but it could be wrong. That would just be my guess, and thinking that if a plan for a large company has thousands of plan participants, there has to be a certain portion of those plan participants who want the option, because as companies move away from pensions, the burden has been put on these individuals, employees, to invest on their own behalf for their retirement. And as more and more people start to ask about Bitcoin and crypto and ways that they can maximize their returns for retirement, it's almost like it's inevitable, like the same thing with Goldman and Morgan Stanley and all those other firms that we've talked about. It's their responsibility to put those options in their plans.
So Fidelity is the top 401k provider by assets.
I would think so. 23,000 companies.
Yeah, they are. They're number one. Number two is Empower. We're pretty familiar with them. I saw that number three is Vanguard, and they said they have no plans of offering.
Yeah, Bitcoin. I did see that too.
It'll be interesting to see if any of these larger providers jump on board. I'm going to guess, yeah.
I wonder why Fidelity
is 4x to everybody else as far as assets. I mean, they're way ahead. So
I wonder why Vanguard would take that stance. Like, we have no intention. Why couldn't you say it's like a wait and see approach or something like that?
Well, like anything, there's always late adopters, right? So Vanguard doesn't have to, right? They just take their 5 bips off their funds, and they've got a ridiculously high revenue company. They don't have to. But Fidelity was that way too. They're low cost, relatively low cost, but it's really interesting to see this dichotomy of one company, both traditional companies, and one taking one direction and one taking the other, and we'll see where it ends up. But as I'll make a prediction that all of these companies in the top 10 by, let's say, the end of next year are offering it. And I'm going to say Vanguard might be the only holdout, and they'll eventually offer it
next year. So end of 23. I was going to say by 25, but
I was also going to make a bold prediction earlier when we were talking about Goldman and Morgan Stanley, and say that they'll allow because the Lightning Network for Bitcoin so efficient now. I bet they allow their customers, their clients, to pay their fees in Bitcoin by the end of next year.
That's interesting. I guess
that's what we do here on this podcast. We make bold calls that no one will ever check us on.
I guess this leads right into an article that you wrote about tokenized stocks and tokenization altogether, right?
Yeah, it's getting published tomorrow. It was really interesting to me for a reason that I'll touch on in a second here. But so there's an option to trade stocks essentially on a cryptocurrency exchange, and that sounds strange because you wouldn't think of stocks being able to be traded in the same place. You could buy or sell Bitcoin or Ethereum or any other cryptocurrency. But what's happened is maybe it's helpful to look at the traditional way of doing things. We wake up in the U.S. on the East Coast at and the market opens at 9:30, right, and then closes at 4. West Coast is a little earlier because it's 3 hours behind. But we take it for granted that we wake up and fall asleep during the hours in which the largest exchanges are open, right? And it's not that way overseas, especially in third world countries. They have limited access to buying and selling U.S. securities, and they're on odd hours anyway, and it's costly. And so we kind of get caught in our own little world here and think, oh, everybody can buy U.S. stocks, but not really, not cost effectively. And so tokenizing stocks is saying that instead of, let's say you, Tim, buying, Google, and then it arriving in your brokerage account, and you hold the shares in your brokerage account, right? This is a little bit different. This is the exchange buys Google, the actual stock from the U.S. stock exchange. They custody it at a company, and that's the collateral for them to issue tokens that mirror or mimic the price of Google. And so folks overseas or wherever, I guess, theoretically, can go out and buy shares of Google at any time of the day and at fractionally. So they don't have to put up, $2,300 for a share of Google or whatever it is now.
Does this mean that I'm going to be working every day of the week soon?
No, I mean, in the U.S., we don't really have a need for it, right? I mean, there's not really I would never want to. I made a joke in the beginning of the article that I woke up at 3 a.m. and needed to buy Apple, but that'll never happen. Maybe for some people, they'll find some sort of edge, in trading that way. But the reason I found it interesting, and there's pros and cons to all of this, and tokens are not stocks, meaning you can't vote. There's no proxy votes or anything like that. Nor can you get dividends from the stocks.
That was going to be my biggest question: is how do you participate in dividends?
So some exchanges will say that they don't pay dividends at all. It's just a tracking of the price, and other exchanges say they'll make their best efforts to pay the dividends, but not guaranteed. Yeah, so it's not a true participant. Go ahead.
Yeah, I was going to say, doesn't dividends, when you're looking at total return, they're a large, contributor to total return in an investment account over time. So if you're missing out on dividends, I guess there's trade-offs with everything, right? So you're doing it any hour of the day, any day of the week at a fractional cost. You have access that maybe you didn't have before, but you don't participate in dividends and voting rights. Yeah. Interesting.
What I found most interesting about this was the concept, the tokenization concept, because theoretically you could tokenize anything. I was just about to mention the thing that we've talked about in the office from a tokenization standpoint, but I'm not going to talk about that. It's too good of an idea. So I'll hold that off until we talk to somebody who's way smarter than we are about it. But the idea that I wrote about in the article is this potentially an option for private companies to gain liquidity that they would normally get through IPOing or going to market through a SPAC or something like that? So I gave an example of what there's founders that, they raised $200 million in one of their series, their fundraising series, and that puts them at a valuation of $1 billion. That's a big deal. But what if they're not mature enough at this point as a company to list? If there's not enough quote unquote seasoning on their financials, that sort of thing. And there's a lot of hoops you have to jump through to list on an exchange. But if a founder has built $1 billion company, or founders have built $1 billion company, they're going to want liquidity at some point. They want access to the money that is all stuck in private stock inside their company. So what if you could tokenize that? What if you could tokenize private stock? And it does two things. It gives access to private equity for individuals who normally don't. So they could buy those tokens and contribute in the success or failure of that particular company. And in turn, those shareholders of the private stock gain liquidity. They can spend that money on whatever they want to spend the money on. So it's just like an alternative. It seemed to me like that at some point there's going to be this alternative route to a liquidity event, and tokenization might be one of those routes. There's probably a huge amount of red flags in doing that, I would imagine. Particularly the financials of that particular company that don't have the same requirements as a public company. But there's probably ways of getting around that, right? I mean, if I do a little bit of angel investing stuff, and even at that low level, there's quarterly reports that I get on the progress folks are making with their most recent seed round or whatever is I'm involved in. So you can make a request. In fact, you could say you can only tokenize if you provide quarterly guidance on your cash burn, your revenue, everything that we normally see. And then the shares would reprice based on any other share that the buying and the selling, the supply and demand of it all prices it out.
Yeah, it creates the share price. That's interesting.
But what if you could tokenize your car? I mean, it's just, car's probably a bad example, but let's say like a Michael Jordan rookie card or something, that goes for whatever, $1 million, or Tom Brady rookie card or something. And you could tokenize that and let other people participate in the value of that card or demise of that card, either way. And it creates a free market.
It helps create a more accurate value for whatever you're trying to create a market for.
Yeah.
Right.
And that was one of the arguments made in a couple articles I read about the tokenization of stocks, is that for smaller companies that are thinly traded, it creates a broader market and better pricing for those particular companies and more liquidity. And would that bring options? More options trading within those smaller companies? So would it lead to more volatility? So there's this kind of path you can go down, positive or negative.
Yeah, I think there's always a trade-off when you're talking about creating something for private companies or anything else that you want to introduce a market for. Whenever there's a market created around a certain product or something that doesn't already have that public market access, there's always going to be a trade-off.
Yeah, absolutely. All right. Time for Pop Chart?
Yeah, I think it's time.
By popular request, we veered away from IPAs.
At whose request?
That was your request. To move away from IPAs and move on to a stout. So this is, I'll pull it up. So it's Allagash North Sky Stout. Allagash is, so we've been doing more local breweries, but this is in Maine. And Allagash is known, well, you know them for their what's it? Wheat ale or white ale?
Allagash White.
Right, Allagash White. And they've got a really good, like, oh man, I forget the name of it now. They've got a bunch of good beers, but they'll age them in certain barrels and stuff like that. So
I don't think I've ever had anything besides the Allagash White, which I guess is their flagship beer. Seems to be the most popular.
Yeah. That's probably the most I've had from Allagash is their Allagash White. They had a double white at one point, which I've never seen again. So I guess they use like a double amount of. I don't know if they use oats or they use whatever they do in that way in a wheat beer. I guess they use wheat.
I got to get better at pouring this. Look how much foam I have.
You're young, Tim. You should be a pro at that.
I should be, but I'm not for whatever reason. I should be a lot better than I am at pouring beers.
You're better if it's like if it's the what's the really cheap beer from that
Natural Light?
No, not Natural Light. What was the one?
Boxer?
Yeah, Boxer.
Boxer Light. They sell it in 36 packs.
Yeah, it's you always want more than 24 with Boxer beer.
It's actually the opposite.
Yeah. Okay.
All right.
Let's try. So 0 to 10. You give the highest score we've had on Wealth Management Mixtape history last week for
Tonewood.
Tonewood
Tipper was a 9.0.
And I went 8.8 on it. So that was the first 9 we've had. All right, let's taste it. So the problem I'm going to have here is it's a completely different genre of beer, right?
It is.
It's measured in a different way. First of all, you don't see many stouts come in a can. That's part of the reason I bought it, is that you don't usually see that. You want to go first?
I'll let you go first because it's your beer. That should be the thing. Whoever's beer it is rates it first.
That's fair. Okay. All right, I'm going to give it a 7.2. I have these categories. Like if it's below a 5, I would never buy it again, probably. Because there's plenty of beers that are over 5 in my estimation, especially these days with how many good beer companies there are. But I'll say 7.2, which is still really good. What do you think? It's very roasty and like.
I was thinking right around that area. Yeah, well, let's see. You're. What are you tasting in the beer?
Let me see if it's written on the can real quick.
Let me do one more.
Yeah, like caramely, kind of like roasted. It doesn't taste like coffee, but yeah, it's good. They say it's smooth, roasted. There you go, and silky. Is that what you're getting on your end?
I guess so. I don't think I'm the best at tasting these beers. You know what? I'm gonna give another even score. I'm gonna go 7.0. A little under you.
I gave a 7 score in Wealth Management Mixtape history, but don't, if Allagash is listening to this, which they definitely are.
Nothing against Allagash.
No.
I thought the other beers that we had were really good.
We also have location bias with those
location bias.
Yeah.
I would have given a 7.1, but I've already given that score out, and I don't think I can have the same score in the first 5 episodes. I think my score needs to change. So it was right under yours. I was going around 7, low 7s, but I'll go with 7.0.
Okay. That's good.
Still a decent score.
Yeah, definitely.
It's above 5, so if you're going by that you'll buy it again.
Yep, definitely. All right, good.
Should I talk about Queen Elizabeth? I don't
Sure.
know. Your dad's the history buff, right? First of all, I need to meet your dad because it seems like he could tell us some cool facts for the podcast. But I was reading the other day, actually in Morning Brew, which I read every day. Morning Brew's great. But Queen Elizabeth, so she just had her birthday, her 96th birthday. I think it was 2 weeks ago. She turned 96, and she actually has 2 birthdays. So one's her actual birthday, which was 2 weeks ago. And then one is in June, where it's a tradition that they started years. I think her great-grandfather started it because he had a birthday in the winter months, and he always wanted to have a celebration in the warmer months. So they always said that there would be a royal celebration in June, regardless of when your birthday is. Thought that was interesting. I thought it was pop chart material.
Worthy. Is it? Would you want to have 2 birthdays?
I don't think it would. I think it takes a little bit away from the one birthday. Would it not?
It's probably she's doing it for the rest of the crew over there, of the royal family, I bet.
I mean, for everybody else, yeah, they probably said, "Why not have a party in the middle of June?"
I think the queen. I think I can't think of the right terminology for it, but the Queen of England and the royal family owns some outrageous amount of land in the world. Like it's some obscene acreage number, if I'm not mistaken. Because people ask, well, how do they have that wealth and how do they maintain it? As opposed to the Vanderbilts, which we'll talk about probably next week, which lost all their wealth within 2 generations. Started with $300 billion and ended up with 0. Ended up with Anderson Cooper, who probably is fairly wealthy. So he had to build it back up himself, though. So anyway,
it seems like he's done fine for himself.
Yeah.
I think that transitions to what we really want to talk about, which is the Sixers.
Oh man!
So the Sixers have Game 6 tonight. Will Doc Rivers be the first coach in NBA history to blow a 3-0 series lead, with their rookie missing a few games, Scotty Barnes, and Fred VanVleet, their veteran point guard, out? Yeah. I think he's doubtful tonight.
All right, I'm going to go ahead and say the Sixers win the night because you can't lose 3 in a row to a less talented team. At some point, the players have to step up. Right? Somebody in the locker room is going to say, like, we got to win, and hopefully it's James Harden, because you can see the strategy. They're doubling down or tripling down on Embiid pretty much every time he touches the ball. That was their plan, at least last game, and they're taking the ball out of his hand to a certain extent. So who's the next logical person to step up? I'm not like knocking James Harden, but he's been disappointing so far in this playoffs for what we probably thought we were getting. And he was great the first couple of games. You know?
Yeah, he's got returned to form. It looks like he's lost confidence in his shot. It just, the way and his demeanor on the court, it's really like tough to watch because it almost looks like he's not confident. I don't know if it's like a regular season versus postseason type thing where he hits like this mental block and he's had all this failure in the playoffs to this point. So maybe he's apprehensive to be aggressive. I mean, we hope not. It's like the same thing. Like history repeats itself 2 years in a row. We have a star point guard, or what we thought was a star point guard in Ben Simmons, afraid to be aggressive. And if he's not aggressive, like, yeah, that's great. He can get everybody else involved to a certain degree. But when the supporting cast, like, you're supposed to be the guy, James Harden. If it's not in Embiid's hands, we need somebody clutch minutes to take over. We need somebody to. You have Maxey and Tobias as well, but it was pretty evident that last game, the plan of Toronto, when Matisse Thybulle was on the floor, was to cover everybody except for Matisse Thybulle and let him shoot. And it proved right. He was 1 for 6, and he looked awful. That was probably the worst game that he's had in a 76ers uniform that I can remember.
We know the one that went in was the one that the other players tipped in on the Raptors.
That's right.
Yeah, so he was actually 0 for 7 with an assist by the Raptors crew over there. Yeah, you're right. He it seems strange because I think it feels like Harden he won't shoot or can't shoot a spot up 3. You know what I mean? He has to do that dribble between his legs and then double step back thing to feel confident shooting, as opposed to just like getting it and being wide open and then, shooting the ball.
Also, just like when he goes and drives, he does the same move where he tries to draw the foul.
He hasn't been getting the calls either.
Hasn't been getting the calls, but how many of those, when he throws it up, it looks like he has enough room, even though he did get fouled, to still make it? Like, how many do you see Maxey make of those baskets through contact that James Harden, he should have a lot more and ones instead of just shooting 2 free throws? Just in my opinion, like, how many of those can he actually hit if he just takes his time? I don't know.
Well, Maxey is different gear because he has to. He's shorter.
He's unbelievable.
And he also goes off his opposite foot. Maxey does. So it's like he's going up for a layup. He's going off his right foot. He's right-handed, which is contrary to everything you've ever been taught, playing basketball. So he kind of throws people off. He gains a little bit of space by doing that, and he's super quick too.
Yeah.
And so he's done that his whole life. Harden, you're right. He's used to getting fouled. He was, I think, the second highest free throw shooter in the NBA. I don't know if it was this year or last year. Embiid's 1 or 2 also. So theoretically, they should be getting a ton of free throws, but he's not getting the calls, and that means he has to score. You know what I mean? He can't just throw the ball up and hope he gets the foul call. I think they win tonight. I think there's enough veterans on that team that they say, like, all right, that's enough, guys. Let's go down here. Let's beat them. Because if they go back to Philly for Game 7,
they're in trouble.
Who knows? Yeah.
All right, so I won't ask you a score prediction because that's too hard in basketball, but
Yeah.
I'll ask you how much do they win by? What's the spread?
I have no idea. Well, basketball games always end with like free throws, so it's just out of reach. So I'll say 5. I think it's close the whole way.
I think so too. I was going to say 7. I think they get a couple of fouls at the end. I think it's like a 3 or 4 point game, and then they win by 7.
All right.
So we'll see.
We will see.